Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Byte. We are shooting this episode on 25th of May. And after two sessions of dragging its feet, and this morning also the Nifty looking like it will succumb to the bear pressure. In the second half of the day, a very, very smart recovery, uh, finishing in the green. And as you can see here, trapping a lot of people on the downside before making this huge 130 point dash. And now we are again just within a couple of percent from its recent high. So the chart action, the price action looks promising again, and the mid caps and the small caps also did quite well. In terms of the heat map, you can see some large cap names like ITC, Bharti Airtel. These were the ones supporting the index along with Bajaj Auto, Adani Enterprise, Bajaj Finance, Kotak Bank, uh, and to some extent Infosys as well. The laggards were Sun Pharma, Tata Motors, Wipro, Hindalco, HDFC, IndusInd Bank, and some stocks were not participating at all, like ICICI Bank, Reliance, TCS, etc. Overall, a reasonably decent day after two lethargic days. So, Bank Nifty closing at 0.0%, so no change in Bank Nifty. Nifty up 0.2%, but the real estate stocks made a comeback. And you can see while they were quiet in the last 1 week, over the last 1 month, real estate is now running almost neck to neck with autos at plus 8.5% for the month. And for the last 3 months, real estate has beaten all other sectors hollow, 22.7% over the last 3 months. Uh, Consumption stocks, infra stocks, FMCG also rallying, and the last few sessions that have been dull have been sort of recouped in many of these sectors. Mid caps, as I mentioned, made another high, another recent high, 52-week high, 33,157. It's heading towards its all-time high very, very soon. Small caps also gaining ground, making a new high, new recent high. No signs of any pressure here, despite overseas pressures being there. Bank Nifty also smartly rallying back. So the last few sessions have been sort of in no man's land between 43,500 and 44,100, and I think we are still jiggling in that before we may take out the top. This is the reason why Nifty has been a bit hesitant. Is the dollar index that has slowed down a little bit in terms of what the FII flows were coming in, but nevertheless, despite the dollar index going up, Nifty seems to be holding ground well. Chart of the day is Lupin. We have a chart of the day to study stocks over a longer period and see what kind of lessons we can draw from them. So Lupin is right now at around 778 rupees, and it is at the same price where it was 10 years back. Anybody who has bought it in the last 10 years, 90% or more of them are sitting in loss. Most people would buy it when there's huge euphoria, so a lot of people would have bought here or would have bought here. So the stock really did well from 2006 or even 2004, you can say, where it was maybe 50 rupees. From 50 rupees it went to 2000, so it went up like 40x in this decade. In this decade, going to 2003 4 to 2014, and then in the next decade it has given up almost 60-70% of that gain. The lesson to draw here is that if you stay with the strength, so if you stay with the trend, you would have made some money here, maybe gotten out here, maybe again bought it here, gotten out here, maybe bought here again, gotten out here. 3 trades maybe you would have taken had you been doing momentum investing here, and making decent money and not having to block your money for the opportunity cost that is potentially available to you over all these years. So maybe you got out at 1400 after getting in at 500 here, but then you would not have had a trade for the next 4 years. Maybe you would have gotten here and gotten out here at some loss, but again for the last few years you would have gotten your money to play some other stock. So today's topic of discussion is, are you in for a quick buck? The slogan being, time in the market is more important than timing the market, and we will see why. So very recently, Mr. Rajiv Mehta uh, did this tweet that 71% of the investors stay invested for less than 2 years, and this is mutual fund data with charts courtesy Money Control, and this is the source of this data is from the SEBI consultation paper on review of total expense ratio. So there is no reason to believe that this data is not true, but it is extremely alarming data when it comes to investor psychology. So 71% of the investors stay invested for less than 2 years. I mean, 71%. 83% of investors stay invested for less than 3 years. So that's the bulk of the market. I mean, 83% investors don't stay for more than 3 years. And just 3% investors stay invested for more than 5 years in an average mutual fund scheme. So you can imagine that those 3% investors are the ones who are likely going to make any money. And of the rest, 97%, in case people were able to come in at a time which was suitable for market growth, they would have made money in 2 years or 3 years. But most likely than not, most of the average returns would have been negative. And we'll see why. So this is that schematic. You can see that going from financial 21-22 to 22-23, the time spent for more than 5 years is marginally up, only 3.09% of the units more than 5 years. But just look at these numbers: 50% within the first year redeemed. So people are coming in for a lottery ticket. 23% for 1 to 2 years. 9.8% 2 to 3 years. 3 to 5 years is 13.96%. So 0 to 5 years is 97%, and there is no guarantee that markets will make money in 0 to 5 years ever. So we'll go through a very classic story about the Fidelity Magellan Fund. So we all know who Peter Lynch is. He's a world famous fund manager. He ran the Fidelity Magellan Fund in 1977 to 1990 period. He delivered an astounding 29% CAGR in that 13-year period. But what is the catch? The catch is that according to Fidelity Investments, the average investor in that fund lost money during Peter Lynch's tenure. So just imagine that a fund manager over this 13-year period, 77 to 1990, has performed 29% CAGR, but the average investor in that fund has lost money. I mean, is it not shocking, this data, and is it not, just a staggering data? So what went wrong? Uh, as I mentioned, time in the market is more important than timing the market. Lynch had exceptional years of overperformance. So, for instance, in 1980, the fund had a staggering 80% performance. Seeing this 80% performance, a lot of people had FOMO and they came in and invested in the fund next year. And what happened the next year? The next year, the fund underperformed. And as you know, more than 50% people just get out of the market within the first year itself. So people lost money in that subsequent year and they left. So the number of people who actually ride the years which do well is always less. The number of people who will ride the way down will always be more. So overall, the averages will get very, very skewed. So disappointed investors keep looking for which is the last year's best performing fund, and they keep hopping from one fund to the other like a chicken, and they get their heads cut off over a period of time. How long should you stay invested? So this is a data that we have calculated for Nifty returns. So January 2000 to May 2023, 23 years of data. The probability of making a profit in this period, if you were invested only for 6 months, anytime 6 months, is 65%. For 1 year, it is 74%. For 2 years, it is nearly 80%. 3 years now gets interesting. 3 years and above is 92% and above. So if you were invested in Nifty, and I'm assuming most mutual funds will perform somewhere near Nifty, although not necessarily. But if we make that assumption, then 3 years is a time where you will likely make 92% probability that you'll make some money. 5 years is that period where it is 99% sure that you will make some money. I'm not saying good returns or index returns. But 7 years is that period where there is no loss possible. So again, I mean, there may have been a period where 7 years you made no gains, but you did not lose money also. That is also not good. So what we want to say is that timing the market is not only difficult, but it can be very, very costly. People trying to hop in, at the fag end of a move, and then not knowing when to exit. So you need to understand what is the strategy. For instance, if you are trading a momentum strategy, you need to understand the concept of it, how stocks are bought, how stocks are sold, how many percentage of stocks become winners over a long period of time, how much is the average win versus the average loss. When you put all these math together, you will find that the returns are very, very superior. So what we have seen in this episode is that you must rethink about stock markets. If you think that you can come in, make money, and go out within a short period of time, or if somebody has very short term money, you know that you're going to buy a house in a year's time. So let me put this money in the market to work for 1 year, and then I'll buy a house. It doesn't work like that. That 1 year may be the most disastrous month of the market, so you will never be able to buy that house if you do that. So allocate accordingly, bring your capital gradually over a long period of time, not 1 year, 2 years, 3 years, over a long period of time. And do not look for just 2 years, 3 years, 5 years type of a time horizon. You need to think long. You need to think decadal kind of time in the market, and then it is sure shot that you will make decent returns out of the market. I hope you get some lessons out of these very important data points, and I hope this video is serving its purpose. And thank you so much for watching, and I'll see you in the next one. Thank you. Bye.